be here talking at Ethereal this year. My name is Hugh Karp and I'm the founder of Nexus Mutual. Often to work out how we progress, we kind of need to look back in history to understand where we've come from. So I'm just going to give you a little bit of history about where insurance has come from and risk sharing and where our vision of it is for the future. One of the earliest records of insurance is from around 3000 BC, where Chinese river merchants used to spread their cargo amongst different ships. And then this way, if one of them sank or capsized, only part of the individual's load was lost. It made the risk was shared together in the community fashion, and society became much more resilient as a result. Moving to 1754 BC, the Code of Hammurabi was introduced. And amongst other things, it allowed the transfer of risk from merchants to moneylenders. And the loans were in fact written off if the merchandise was lost or abandoned or stolen. And it's actually quite important because this is one of the first examples of risk being specifically transferred from one group of individuals to another who are more able to handle the risk. Expanding on this further, the Phoenicians and Greeks invented bottomry loans. So the way this worked was backers of merchants would provide a loan to fund a voyage, and they'd profit if the voyage was successful. But if the ship's cargo was lost to pirates or bad weather or for any other reason, the loan would be written off. And this is the first commercialization of insurance that's starting to grow and expand. Returning more back towards community-based solutions, craftsmen in the Middle Ages would often join a guild. It provided them many benefits, but what they would do is they'd pay an annual membership fee. And it'd also include support. For example, if their workshop burnt down, the rest of the guild would pay to rebuild it. Or if they died, their family would be looked after. So these became the first versions of more formalized life insurance policies. In the 17th century, insurance started being backed by individuals or even groups of individuals. Ship owners or merchants would publish a sheet of information to describe the cargo, the destination, and any other pertinent information about the voyage. Those who then accepted the risk wrote their names under the description and the terms. And this is where the word underwriting came from. So these groups of these underwriters discussed the deals and the terms in Lloyd's Coffee House, which then later became known as Lloyd's of London. And this brings us up to insurance, I guess, as we know it today. Big insurance companies diversifying risk across product lines, geographies, and many other factors. Commercialization of the process has been pretty much completed. There's a heavy focus on capital efficiency, including regulatory arbitrage, where risk is shifted to the most favorable jurisdiction, where perhaps the regulations are a bit lax or less capital needs to be held. Alignment of interest is now at its weakest, with end consumer and insurance company directly taking different sides. Heavy regulation is required to address two main issues. The first one being agency risk, which is essentially the risk of the insurance company managing the money on the customer's behalf. The money insurance company holds is essentially there to pay future claims and after taking a fee. So if that's mismanaged and the claims can't be paid, it creates big issues for society. So regulators step in with many rules, requirements, how that money should be managed, how much capital, how much money should be held, and make sure the people with the right skills are in the right places to do it appropriately. The other main reason for regulation is heavy information asymmetry between the customer or the insured and the insurer. It's very hard for the general public to know how reliable or how solid or stable a particular insurance company is. So the regulator is there to provide minimum standards and transparent reporting on the financial position. I've alluded to this a few times so far, but this kind of gets to a fundamental concept in insurance, which is actually about connecting the customer who has risk with capital that wishes to take it on. The entire evolution of insurance has actually been driven by the relentless need to optimize capital efficiency. The more effectively insurers can coordinate capital with risk, the more profitable they will be and the lower the end cost to the consumer. If we go all the way back to the Chinese merchants, both customers and capital are effectively together. Capital is relatively small because the customers aren't deep-pocketed. They are merchants and traders trying to make a living. They're essentially just sharing risk together. In this model, interests are much more aligned as capital is intrinsically linked to the risk. They're effectively in the same group. But this model often struggles to scale because the capital can only be accessed within that small group. It can't necessarily grow big. It must remain within that community or is constrained by the size of that community. As we move to the shipping merchants, the money lenders step in and start providing capital. Risk starts being transferred further from its source as it's easier to access capital from outside the community. The commercialization process starts. With Lloyd's, the drive for easier capital formation continues. Wealthy so-called names provide the capital. They even join syndicates that jointly back specific risks, and the commercialization process continues, and the capital moves further and further away from the customer. With modern insurance, capital is now very distant from the end customer. Capital efficiency is very high, interest alignment is low, and frictional coordination costs of all parties are high. There are many parties in the value chain, and so much of the process is still manual and paper-based. This results in at least 30% of the premium being lost in inefficiencies. If you walk around the square mile in London today, then you can see just people, mainly men in suits, working around with folders full of paper, still ferrying information from the insurance companies or the reinsurers to Lloyd's and other capital backers to sign terms and agreements. Nexus Mutual's aim is to bring insurance back to its roots of community risk sharing. The difference is that we now have Ethereum to supercharge the capital formation. Token economics and incentive mechanisms can give us new tools to massively reduce coordination costs. And this is what Nexus Mutual is fundamentally about. Efficient capital coordination where all the benefits are handed back to the members of the community, and rather than being passed on to capital markets and for shareholder profit. It's all about handing the benefits back to the members of the organization. We're starting by offering a community-based solution for crypto-native risks. Insurance is fundamental financial infrastructure for every economy. If you need to build a bridge, you need insurance. If you launch a satellite, you need insurance. If you build a railway, you need insurance. Doesn't matter what you're doing, really. Insurance is just there. Problem is that crypto and DeFi and Ethereum virtually have no access to insurance. It's really hard to get the regular institutions, the regular insurance companies to provide any meaningful cover. They are there on the edges, but they've got a long way to go. So essentially, we're building a community-based solution to tackle these risks ourselves. Our first product is smart contract cover, which can be used to protect against bugs in Solidity code. It's a community-based solution for a community-specific problem, but it's just the start. Nexus Mutual's vision is actually much greater. The protocol can be scaled to cover any type of risk. You can cover crop insurance, earthquake cover, shipping, and I'm sure many other product lines. We've created a generalized platform that we should be able to price any risk that we wish to, as long as we get enough members and enough scale to do so. Our goal is for one day Nexus to be a competitor to the large insurance companies, but one that's fundamentally different. One that hands all the efficiency and coordination benefits back to its members. One that works for its customer base and its membership organization, and gives them all the benefits of sharing risk together. Keep it short and sweet, but if you'd like to find out more, then head to our website or message me on Twitter. But yeah, thank you very much. It's been great to present.